Greetings. Today is Monday, May 12th. A couple weeks ago, we got the advanced estimate for first quarter GDP, and as you know, it was barely negative. Now, it is very common for these advanced estimates to get revised, so this number is not the final number. So it remains to be seen how bad that first quarter actually was. But I'm going to show you there's a few data points that we want to zero in on that are suggesting that we might just very well avoid a recession. First up is the leading economic indicators according to the Federal Reserve database. And what I want you to see is that as you're approaching a recession, the leading indicators turn over and head south. What's happening right now? We're really still expanding. So this is not suggesting that a recession is nearing. The next thing that I'd like to take a look at is from the Chicago Federal Reserve. And again, what tends to happen as you're going into recession is the financial conditions tighten. And while they have picked back up, it's barely above the zero line. So I would suggest that this is also not recessionary. So those two data sets are indeed leading economic indicators, but one of our favorite leading indicators is the stock market. So on the screen right now, I've got the S&P 500 in the top pane. The bottom pane is the advanced decline line. If you're not familiar with that term, the advanced decline line simply takes the number of advancing stocks and subtracts the number of declining stocks. If the line is pointing up, it tells us that we have more advancing stocks than declining. And right now, the advanced decline line is pushing all-time highs. That is indeed bullish. However, as people who are in charge of managing other people's money, we have to look at things with a risk-first mentality. And so as impressive as a 15% rally has been, we have to guard ourselves against bear market rallies. So one of the things that would convince me a little bit more is whether or not we could break through this pivot. I drew this on my charts this weekend as kind of that one of the lines in the sand. What happened this morning is the S&P is gapping above that pivot, and it has even broken the highs from March. So that is very welcome news. Now, as you know, if you've been following our channel, you know that when we're managing equities, we usually use 4 different equity strategies: 2 quantitative strategies and 2 tactical strategies. Well, recently, one of our quantitative strategies did indeed give us a buy signal. But by itself, that doesn't mean that we're going to change everything that we're doing. We're simply going to continue to follow our investment management rules. If you have any questions, if you want to learn more about how we manage money for others with a risk-first mentality without giving up growth, by all means, send us a DM. We'd be happy to see if we can be of service.